Hi everyone, hope you are doing well. So I assume that you have already watched the previous session because again it is the continuation of previous one. There are so many concepts in this session which have been related to the previous one. So I will not be repeating those things again and again. Okay. So I would request to watch previous session first and then come to this one. Okay. And for this particular one today I'll be discussing about financial market and its instrument. And if we see the PYQ trend, then you see there are increasing number of questions from this portion, and in 2024 it was too much. There was 5 questions from single portion. So you can I do not need to tell you the importance of this session and again the coming one. Okay. So without wasting any time, let's come to the terms first and see. In this particular session, this particular portion, financial sector, is the combination of both facts as well as concepts. Why both? Because there are so many terms. If you understand those terminology in proper manner, then you do not need to learn so many things. You can do it using logic as well. Okay. But again, there are so many terms, so there you have to understand the minute difference between different terminologies. So that is the factual aspect again. That's why it is the combination of both, and you have to be very mindful while studying this one. But again, it is easier compared to the banking portion what we have done. There were so many graphs and conceptual things. Okay, but here it is bit easy, so don't worry about it. Okay. So again I would request to please bring your notes with yourself so that you will be marking the importance one, important terminologies and important things along with it. Okay. So first thing is fixed and working capital. So I hope that you are already aware about the capital meaning. Suppose I have 100 rupees. Okay. 1 lakh rupees. Okay. And I have a two option, either to build a room where I can sleep or where I can stay. Okay. And another, to build a room where I can open my shop. Okay. So there is a difference of intention and a difference in the means how I'm going to use that room. Okay. So if I am using that 1 lakh rupee to build my room where I can stay for my personal consumption, then that is not capital. But if I am using the same money for shop through which I can earn, that will call capital. Okay, because I have started a business and I have infused money into them to earn something. So that is called capital. Capital means an amount of money that you use to start a business or to put in a bank, etc., so that you earn more money on it. Okay. So again, there are two types of capital, fixed and working capital. It is very easy, I know, but just for the revision one. So fixed capital. Suppose just to have this session, I have laptop with me, I have writing pad, I have pen, I have headphones on, right? And I am using electricity as well. So right now, to have this session, this laptop, this writing pad, and this headphone is the fixed capital. Why? Because if I am taking more lecture, I am not going to increase the number of laptops, number of headphones, and all these things. It is one time investment and can sustain for longer period of time. Okay, so that is fixed capital. But just to have one more session, I'll be using more electricity. So electricity charges are working capital, because with more number of consumption, with more number of production, I'll be using more number of inputs into it, and whatever the inputs I'm using, the cost incurred on it will be coming under working capital. Okay. So I this is the easiest example I can give. Like whatever with production, if cost is increasing, that comes under working capital. And if you have incurred the cost at one point of time and you are not changing it again and again, then it is called fixed capital. Okay. So working capital used for daily operation and short term needs, right? Fixed capital invested in long term and asset to support the business operations. Example, cash, inventory, account receivable, payroll comes under working capital. Salary as well. Fixed capital, building, machinery, equipment, vehicle, land. Okay. Factory units, all these comes under fixed capital. Liquidity, I have already explained in previous session that liquidity through which you can easily transform into cash. Okay. For example, if I am going to purchase sell this laptop, then I have to be like I have to wait for the buyer who can give me enough money for this laptop. So this is not easier in terms of liquidity. I cannot get liquidity in the very first front. But if I am offering someone to use electricity in my room, and I am charging them based on the unit per unit of consumption, then I can easily convert into money, right? So that's what liquidity, working capital have a higher liquidity because they are related to daily operations. But the fixed capital one have a lower liquidity. Is suppose you have a laptop and you have a land, किसको बेचना इजी होगा मार्केट में? It will take time to sell your land, okay, because that is having a higher cost, but it will take lesser time to sell a laptop. So again, it is a subjective what kind of parameters you are taking. If you are taking laptop and electricity, then electricity have a higher liquidity as compared to laptop. But if you are taking laptop and land, then laptop have a higher liquidity. Okay. So I hope you have understood the meaning of liquidity. So how working capitals are highly liquid, easily converted to cash. Fixed capital have lower liquidity, not easily converted to cash. Okay. Duration again, working capital for short duration and fixed capital for longer term. Usage uses to cover immediate expenses, again the same thing. But I hope that you have understood the difference between fixed and working capital. See, this question is not going to come directly into exam that what is fixed and what is working capital, but it is very very important to put logic when it comes to using and solving PYQs. Okay, so that's why understanding is important right here. Okay, so when we are talking about the instrument in financial sector, there are so many instruments and there are so many categories as well through which we can divide. The same instrument can be for shorter no, a shorter period, but can be under the external sources as well. So it depends. There are so many categories. So on the if we are taking first category, that on the basis of period, if we are taking, then there are three kinds of instruments: short term, medium term, and long term. Okay, so in short term, trade credit, factoring, commercial papers. In medium term, loan from bank, public deposit, loan from financial institution, and then lease financing. Long term, equity shares, retained earning, preference shares, debenture, loan from financial institution, and loan from banks. Okay, I'll be explaining the meaning of these terminologies because they are highly relevant from an exam perspective. Okay, so just wait for a moment. In coming slide, I'll be discussing them all. Then on the basis of sources, there are two types of sources: internal sources, external sources. Internal sources, that in organization there can be multiple stakeholders through which I can earn and get money from them as well. Okay, so equity, share capital, and retain earning are those sources. External sources: financial institution, loan from bank, public deposit, again the same thing. Then debenture, lease financing, commercial papers, trade credit, factoring. These are external sources through which we are getting money or borrowing money from external market sources. Okay. Then comes securities. Securities are financial asset that people or companies buy and sell to raise money or to invest. Okay, securities means, agar if in simplest language you want to understand or you want to relate, then you can call securities means collateral kind of thing. Okay, security, that means if I am investing somewhere, then I should have some agreement. I should have in tangible or intangible form, I should have some agreement with me to show that I have invested there. Okay, so it is a kind of financial asset. Okay, if it is in house form, suppose bank used to take collateral, they used to take house, so that is collateral for them. Okay, but if we are investing somewhere, we are getting agreement in our hand, so that is called securities. Okay, so securities are financial asset that people or companies buy or sell to raise money or invest. So there are four kind of securities: debt security, equity security, derivatives, and hybrid securities. Again, so debt security, first one. Debt, simple meaning loan. Debt means loan. Okay, equity means ownership. Okay, derivative mean derived. Derived. Hybrid means mix of loan and ownership. Mix of loan and ownership. Okay, now coming to this one, debt securities. Suppose I need 100 rupees. Okay, I am going to start a business. In one thing, I'll be explaining all. Suppose I am going to start a business and I need 100 rupees to invest into my business. So I have three options for me. Okay, first is debt securities. I mean, first option is to ask for a loan. Okay, so suppose I want to start a business, and I am asking for 100 rupees from you and saying that I'll be paying 2% interest on it after a year, and I'll return to you. Okay, so that is called debt securities, that I am taking a loan from you. Again, second thing, I am offering you that give me 100 rupees, I'll give you 2% of share in my equity, in my shares, in my ownership. So that is a kind of, not exactly partnership, because partnership firm are different. I am talking about the company's term. Then here there will be equity shareholder, so you are a 2% shareholder in my company. Okay, so whatever the profit I'll be earning, I'll be giving 2% out of that profit to you. Okay, so equity securities, in loan, in debt securities, I am paying what? Interest. Okay, but in the equity securities, what I'll be giving? Share from profit. Share from profit. Okay. Then derivative securities. Suppose I have given you some sort of instrument and saying that if my stock value goes up to this level, then out of this stock, I'll be giving is to value like 2% of this stock value to you. That means you are deriving your profit out of something else that is dependent. That can be in any form. Company can give a various options, different opportunities to their creditors, that if my this value of my this asset is increasing, I'll be paying to you on the behalf of this. Okay, so derivative securities. Then hybrid securities. Suppose I need 100 rupees, I am saying you that, look, give me 100 rupees, I'll pay you 2% interest after a year, and then I'll again convert your loan, your debt into shareholding. So right now, you are my creditor. You have taken, like, you have given me a debt securities. Okay, I'll pay you 2% interest for a year. After a year, I'll give you 2% of shareholding in my company. So what I'm doing, that I am making the combination of both debt and equity. That is called hybrid. Okay, so I'll be explaining again in coming slide, but here because I started this point, so it would be better to give you the glimpse of it right here only. Okay, so equity security and debt security. Equity, owner. In equity, so because I am giving you shareholding, right? So you are a owner of my company, and you'll be getting dividend as well as profit only when company earns sufficient profit. Again, profit, you, if you are earning profit, you will be getting dividend, and you have voting right as well, because you are, when you are owner in my company, whatever the decision I am going to take, you are also going to be affected by it. That's why you have a voting right. If because of my decision, profit of company is going down, then you will be also be affecting, because you are getting lesser amount of your profit, right? So that's why, then it is not secured, yes, as compared to debt. Because if I am giving you loan, and I like, if you are giving me a loan, then you are sure that after a year I'll be giving you 102 rupees for sure. But if you are giving me equity security, that means if I am earning 10 rupees, then I'll pay you 2 rupees. Then it happens only when I am earning 10 rupees. What if I lose 10 rupees? Then you are not going to get anything. Okay, so that's why equity security is lesser secured as compared to debt security. Okay, and share capital of the company, and in debt security they are the borrowed capital of the company. Okay, same thing is here also. Bond is the same debt security. In debt security there are there are multiple kind of security. There is a bond, there is a debenture. I'll be discussing in coming slides. Okay, then comes financial market. In simplest sense, financial market is like a vegetable market. In vegetable market, you have a physical thing, physical exchange of goods. Okay, there is a vendor coming and selling you the vegetable, and you are purchasing it. Okay, but sabji mandi, vegetable market, and financial market, there is a exchange of funds. There is a someone who have so many funds, and they want to invest those funds and earn interest, earn dividend out of it. They have surplus money. Okay, and there is a person who have a fund scarcity, and they need fund to start a business, to do something so that they can earn something. Okay, so there is a fund scarcity on the other side, so to start a business, to grow business, to cover unexpected expenditure. So where they will be doing all these things? So the marketplace where they are doing all these such activities, that is called financial market. Okay, so this is simplest thing. I hope that you are aware about it, so no need to explain more. Then financial market are of two types: money market and capital market. Okay, see, financial market, I'm not saying that there is a tangible place. I can tell you that, see, you if you go to Bandra in Mumbai, then you will be getting this financial market. No, it generally happens in broad level, like cloud storage, online, internet. So you'll find this there. Okay, there is a SEBI who used to regulate it, the capital market one, and there is a stock exchange place as well. There are different places of those stock places, but financial market is a broader term. It is not present in a tangible form. Okay, just a second, let me clear this line. Okay, so financial market are of two types broadly: money market and capital market. Money market simply shorter term financial market up to a year. If something, if any kind of securities I am trading or any kind of fund exchange I am doing within a year, then that will come under money. And if it is more than 1 year, more than 365 or 364 days, 365 generally, then it is capital market. Okay. So first I'll be talking about money market, and then I'll be going to capital one. Okay. So money market. Again, money market, there are two kinds of money market: unorganized, organized. Simple. Organized and unorganized. First I'll be talking about organized, then unorganized one. Okay. So organized market, organized money market is regulated by RBI. Okay. Please try to learn it, because money market is regulated by RBI and capital market is regulated by SEBI. Mostly, not all aspect of capital market, but most of the capital market aspect is regulated by SEBI. Okay, there are some important small things which are regulated by RBI, but SEBI has a broader role in capital market. Okay, in money market, RBI. Okay, so in money market, in organized money market, it helps to protect the investor and depositor. It helps in preventing financial fraud and promotes stability and confidence in the financial system. Simple hai, if organized and organized, the major difference is the regulator presence. If there is someone who is regulating each and every activity, then it is called organized, and vice versa happen in unorganized. So you also know the benefit of organized when there is a regulator, when there is someone who can look after the misusing of any kind of activities or any kind of illegal activities, then they can punish them as well. Okay, so this is how they used to protect the interest of investor. Okay, so in organized money market that happens, but in unorganized money market there is no regulatory body, and there is a huge unorganized money market in India since ancient times and even in today's time. Suppose you'll be finding so many people around you who used to give loan for 6 months, 7 months, and they used to charge higher interest rate as well, like 15%, 20% out of it. Okay, so that happens. So money lender, indigenous banker, and unregulated NBFCs. So first one, indigenous banker. We understand our people, like indigenous banker are like Mahajan. You used to know, used to term this word Mahajan in our locality, and Jamindar. What they do, Jamindar is also money lender, but indigenous banker as well. That they know the specific requirements of their region, and they are easily approachable to them as well, and they are flexible as well. Like if I am taking a loan from bank, I have to repay it in a 6 month if it is maturity for 6 month. Okay, but if I am taking loan from indigenous banker and I am requesting them to please, I have a so many issues, there is so many scarcity I have, I cannot pay now, please give me 2 months or 3 months, then they can do that. So this, in somehow they are also flexible as well and operating since ancient and medieval times. So because of approachability and flexibility, still today farmers or even small vulnerable section are not going for banks credit. They are mostly relying on indigenous banker or money lender, because of these two reasons, right? So indigenous banker are like they also belongs to community, and there are some terminology either you learn or just have a glance, nothing so much to give importance here. So indigenous banker are Gujarati Shroff, Multani or Shirkarpuri Shroff, Chettiars and Marwari Kayas. So they are just known for as an indigenous banker. That's okay. Just have a glance. Nothing to remember much. Okay. Moneylender unregulated NBFCs, again unregulated and regulated. If NBFCs are regulated, then specific type of regulated NBFCs are NBFCs. Okay, simple, because in banking chapter we have understood the role of NBFCs and their regulation by RBI. So they are there. Okay. Then unregulated. Unregulated NBFCs, the non-banking financial intermediaries, similar like indigenous banker, money lender, they also used to do the same kind of thing. What we call chit fund. They have also, high chances of being bankrupt or just running away after taking people's money. So chit fund, all kind of things. Okay, and then money lender. Then money lender is same, so no need to explain again. This one in money lender, that happens to bonded labor, because if any vulnerable section have taken money from money lender and they are not able to pay it back, they will say that okay, you have taken 1,000 rupee from me, so then do this work for me. So probably that work cost 10,000, but they are just doing it within 1,000 for 1,000 because they have taken loan from this money lender and they do not have money to pay it back. So that is a kind of exploitation and bonded labor. Okay. Then comes money market participants. So now we are coming to organized money market. Okay, organized money market. So in organized money market, there are different participants as well. First one is RBI on behalf of government. Okay. See, as per the FRBM Act, RBI itself is not allowed to be participants or to sell and buy government securities on themselves, on behalf of themselves, to regulate all things. RBI is not allowed. I will be explaining in public finance again. Why? Because if RBI is doing anything like that, they will have to print currency. And printing currency is not a good option for any economy per se, without having backing in form of gold or any kind of things. Okay. So whatever RBI do in money market, it is on behalf of government. Okay. So even in banking chapter, I have explained that in open market operation, RBI used to sell and purchase government securities on behalf of government. Okay. Then comes bank. Bank used to take demand deposit and time deposit, except RRB, regional rural bank, are not allowed to do all sorts of activities. Okay, regional, because they are purpose specific banks. Okay, so they have something specific to do and they are mostly focused on that aspect only. Then comes NBFCs. In NBFCs, I have already explained that they used to take time deposit, not demand deposit. Okay, then top rated corporates, who have got credit rating from RBI approved agencies such as CRISIL and ICRA. Means they have a reputed corporates. Not any corporate can involve into it. Okay. Then individual. Those individual, again, high profile individual, they have a large capital itself with themselves, so they are also participants of it. Okay. And also, in this one, RBI is not going to do exchange with all other participants in the money market. RBI used to do only with banks and NBFCs. Okay, so RBI is not trading with corporates and neither with individuals. Okay, in OMO, last year only, in open market operation, there was inclusion of individual through retail investors scheme, but that is separate thing. Generally, in money market, RBI does not use to trade with corporates or individual. They have nothing much to do such activities with themselves. Okay, it have already came in PYQ. That's why I am emphasizing on it. While in PYQ, they have asked that RBI used to give loan to corporates in case of dire emergency. So that is wrong. RBI used to give loan to bank and NBFC, not corporates. Something statement was similar statement was there in PYQs. That's why. Okay. Then bank used to trade with all. Okay. NBFCs, again, because they are the connecting link between the corporate individual and the RBI. Okay. And then corporate used to trade with all except RBI. Same with individual, they used to trade with all except RBI. Okay. Then comes money market instrument. There are so many money market instrument, and again, initially only there was an instrument short period, long period. There was a I let me open that slide here. There are so many terminologies. So now we are going to understand those terms first, okay? And first, I'll be talking about the instrument in money market because they are specifically to be mature within a year. Like they have a limited maturity of 1 year. That's it. They cannot trade beyond a year. That's why they are called as money market instrument. Okay. Then, who is regulator? RBI. I have already told. Okay. So in money market, RBI used to sell government securities or issue government securities at discounted price. I am talking about treasury bill. Treasury bill, okay? Treasury bills are government securities for shorter time. Simple thing. If if government securities are for, sorry, if government securities is for longer period, 2 year, 3 years, then it is called government securities. I'll be explaining in coming month. But if government securities are for within a year, then it is called treasury bill. Okay, and it can be issued for 91 days, 182 days, and 364 days. Earlier there was 14 days period as well, but right now it is not allowed. And on there is a replacement of 14 days treasury bill with cash management bill, this one. Okay, so for now just try to learn this fact as well, that treasury bills are issued only for 91 days, 182 days, and 364 days. Okay, and what RBI used to do here, that they used to issue the securities at discounted price. Suppose that treasury bill is worth of 1 lakh and they have issued it for 90,000, and they are saying that after a year I'll be purchasing, or even someone else is trading in the secondary market, after a year they will be getting 1 lakh with them. Okay, so there is a profit of 10k, 10,000 on this government security. So what RBI used to do, they used to sell this government securities at a discounted price. Okay. Then comes cash management bills. As I said, that if it is for lesser than 91 days, then it is cash management bill. Okay, see, be it treasury bill, be it cash management, just a second, let me clear it. Be it cash management bill, be it government securities, whatever, all these securities are issued by government. Okay, who used to do that? RBI used to do that. Okay, so RBI used to you issue it on behalf of government. Okay, so whatever the interest paid on it is also by government, and whatever the money RBI is getting by selling these kind of securities, they used to transfer this amount to government as well. Okay, so treasury bill is a kind of collecting money for the government, borrowing money from market. Okay, so whenever our government is needing some sort of money for a year, they used to issue treasury bill. So if there are immediate purpose for government as well to collect some money, to borrow some money from market. Okay, so at that time below 91 days they can go for cash management bill issue. Okay, so if government is needing money for 30 days, suppose, okay, then they will issue cash management bill in the market again through RBI, and they will be getting money out of it. Okay, so cash management bill are short-term money market instrument introduced by Government of India in 2010 in collaboration with the RBI. These bill cater to the government immediate cash requirement by addressing temporary cash flow gap. Compared to T-bill, CBM poses comparable characteristics but are issued for less than 91 days. See, there can be a question or difference between treasury bill and cash management bill. Okay, so first is both are money instrument, the money market instrument similarity, but difference is treasury bill can be issued only for 91 more than 91 days, and cash management bill for temporary purpose and only for temporary purpose. If we are issuing more than 90 days, then it will be called treasury bill, not cash management bill. Okay. Features. Maturity. CBM have maturity period of less than 91 days. Discounted redemption similar to treasury bill. CBM are issued at a discount and redeemed at a face value. Same thing. They are also issued at discount. Okay. Then flexible tenure. The tenure total quantity of CBM to be issued and date of issuance depend upon the temporary cash requirement of the government. Okay, then SLR, this one is important. SLR eligibility. CBM are eligible as statutory liquidity ratio securities. Banks can consider investment in CBM as valid investment in government security for SLR purposes. Okay, as recognized under Section 24C. I have already explained the kind of securities bank need to purchase under SLR. Okay, so CBM is also allowed into that one. Okay, then market mechanism, same thing. There is nothing much important. Settlement T plus one basis, non-cooperative, non-competitive bidding. Unlike treasury bills, CBM are not covered under non-competitive bidding scheme. Okay, so there is for treasury bills there are auctioning process, but here there is no auctioning process. Okay, then tradable nature, also CBM are tradable and qualify for the ready forward facility. So again it is tradable in secondary market, and even in money market whatever you used to sell and purchase except few many other securities are tradable in secondary market. Okay, then liquidity management and the deepening interbank market, that's it. Major features I have already explained, and that is only thing you need to remember. Okay, so there is no need to overburden with yourself to have so many information. Then certificate of deposit. See, I am a bank. Okay, I need some money. I went to RBI and asked for money, but that is not being enough for me. So I need to borrow from market at that moment. So what I'll be doing, I'll be issuing certificate of my deposit, that I have this much of deposit. This is the certificate. You purchase it. I'll be getting some money, and whenever you want to sell it, I'll be taking it back. So in form of securities, because if I want to have some money, borrow some money from market, I have to give some sort of securities. But I have a limited security with me, or I just want to use this certificate of deposit technique as well, tool as well. Okay, so this is another one of the method through which I can borrow from market, being a bank. Okay, RBI does not used to do that, bank used to do that, because bank are taking deposit from people. Okay, so they are unsecured short-term debt instrument issued by banks in the money market. Bank issue certificate of deposit when they need fund but don't have enough deposit on face high borrowing cost from repo rate. Okay, reason for 2023 increase in 2023, bank issued more certificate of deposit because they had many loan application but not enough money to lend. Okay, so they had, like, they have to increase money supply and money liquidity with themselves, and they want to give so many loans. So to have that money, they were borrowing from market by issuing more certificate of deposit. Okay, no need to remember much. You can just remember that it is also one of the method of money market instrument through which bank used to give security, certificate of deposit as security, to borrow from market. Okay, and it is a short term. CD can be bought and sold easily in the market, and no collateral or asset are pledged against certificate of deposits. Okay, simple thing. This one is also need to remember. Just a second. This it needs to be, the certificate of deposit needs to be in minimum amount of 1 lakh, and it should be a multiple of 1 lakh. So you cannot issue 1 lakh 35,000. You have to do 1 lakh, 2 lakh, 3 lakh, 10 lakh, 35 lakhs, 40 lakhs, something like that. Okay, so there should be multiple of 1 lakh, and minimum amount is 1 lakh. Okay, then comes commercial bills. Okay, see, uh, this is majorly to solve the issue of small businesses, MSMEs particularly. Suppose ABC and XYZ. There are two firms. Okay, ABC have purchased some raw material to XYZ. Okay, and XYZ is saying that, see, I have requirement, I am taking a raw material from you, I'll be producing it, I'll be selling into the market, then when I'll get fund, I'll pay you back, because right now I do not have money to pay you back. Okay, so I'll pay you after 2 months, after 3 months, after 5 months, based on the kind of requirement and the kind of process I need to do. Okay, so at that time ABC have already delivered their product but have not got the return. Okay, so at that moment what they will do, that they will say to XYZ that, okay, if you want to pay me after 2 months, that's okay, but give me this certificate, bills of exchange, that after this period of time you will be paying me this much of amount. Okay, so XYZ will be, being a buyer, XYZ will give bills of exchange to ABC, that it is a kind of agreement which shows the maturity period, that after this point of time, and after 6 months, 2 months, I'll be paying you this much amount in lieu of for purchasing this and this thing. Okay, then ABC will go to SDFC Bank and will say that, look, I have a bills of exchange, you take it. Okay, and suppose this, after a 2 month, XYZ needs to pay 100 rupees to X by X ABC. Okay, then after getting bills of exchange, ABC will go to SDFC and give this bills of exchange to SDFC and say that you give me 98 rupees. Okay, you take 2 rupees as your benefit, as your profit. So it is again a kind of discounting thing, that you give me the lesser amount, but I need liquidity right now. I need to use this 98 rupees to again purchase some sort of raw material for my production. So I need that money right now only. So you pay me 98 rupees, and when once after 2 months, when XYZ will pay, they will pay you to you, not me. Okay, so at that moment, SDFC will be getting 2 rupees in this process. They are giving 98 rupees to ABC by taking their bills of exchange, and once XYZ is paying to SDFC, the XYZ will pay 100 rupees to SDFC. Okay, so what is this process? Bills of exchange. All these things are known as commercial bills. Okay, so what kind of, I hope that you have understood the concept of bills of exchange and commercial bills as well. There is also one term, factoring, I'll be discussing in coming slide. Factoring is also similar to this. Okay, so this one, commercial bills. In commercial bill, there all this AI, All India Financial Institution, NBFCs, banks, mutual funds, all are yeah, allowed to do such activities. Okay, so if there is a NBFC running in my region, I can do the same thing with them as well. That I can go to them and ask for some money at a discounted price by providing them bills of exchange. Okay, so that happens. And why it is important to do, and important for MSMEs particularly, because smaller businesses have not much too much time to sustain in business without having money with themselves. So if XYZ is not paying to ABC, how will ABC will cover their further production process, because they have a limited fund. Okay, so being MSME, being a sorry, ABC being a MSME, it is needed to have some liquidity with themselves. Okay, so that happens. Then comes call money. Call money is majorly, see, whenever banks are needing emergency fund, they used to go to RBI for overnight borrowing, for 14 days borrowing, for 20 days, 1 month, depends what amount of money they need and what for what purpose as well. Okay, so if they are doing it for one day, for overnight, okay, then it is called call money. If they are doing for 2 to 14 days, then it is called notice money. Okay, so cumulatively you can also call money for 1 to 14 days, but if you want to segregate further, then call money is for overnight borrowing and notice money for 2 to 14 days. Okay, then and this one, when bank need money for a period of 1 to 14 days, then they can borrow money in interbank money market called call money market. Okay, interbank money market, because they are not taking from RBI directly, they are taking it from interbank money market. Even if stock, if you are coming from commerce background, you must have do a ledger entry. There was a call money. Whenever you purchase stock prices, shares from stock market, there was an entry, that very first entry was call money, then you were paying further process payment into it. Okay, so call money is the very first initiate process. You do not need to go into that, that is the technical aspect in accountancy. So if you have not understood it, leave it. Okay, but for now, call money is the overnight borrowing market, that's it. And who is allowed to lending here, I mean giving money here, then scheduled banks, commercial banks, cooperative banks, AIFIs, selected insurance companies, then selected mutual funds. And who are allowed to borrow, then only commercial banks and cooperative banks, not AIFIs, not insurance companies, not mutual funds. Okay, so by using a logic as well, you can say that RBI has already given so many opportunities to different kinds of institution to avail money. Okay, So having this overnight thing is not being encouraged for such purpose specific banks. Okay, so only commercial and cooperative, because they are reliable, they are more trustable, they are allowed to do both lending and borrowing. Rest are hindered from doing borrowing activities. They are being discouraged for doing so, because even taking money for overnight is not a appreciable thing. It shows that your business is not going in a proper manner. Okay, then comes repurchase agreement. Repurchase agreement, repo rate, I have already explained in banking thing, so there is no need to explain it here again. I would request to go and watch that session. That is highly important, and you cannot afford to skip it. Okay, then comes commercial papers. This one, I would suggest to just to watch those session. Then commercial papers. Okay, commercial papers mean similar to commercial bills. Okay, here what happens? Top rated corporates, whenever they used to get some borrow some money from market, they used to issue security. I told you that when bank used to security, they what they used to issue, they what they are issuing. I think here they was issuing it. Just a second. Certificate of deposit. Okay. So when banks are issuing, they have a deposit, they can issue a certificate out of it. Okay. But corporates are not having that kind of deposit. So what kind of securities they can issue to borrow money? So they issue commercial paper. Commercial papers can be having some sort of biodata of their assets, their different kinds of projects, something like that. Commercial paper is a accumulated broader term to include all those financial asset of their any corporate. Okay, so when corporates are issuing some sort of security to borrow money from money market, then it is called commercial papers. And again, it should be in multiple of 1 lakh, and minimum amount should be 5 lakh. Okay, so for banks it was minimum amount for 1 lakh, but for corporates it is minimum amount of 5 lakh. Why? Because corporates only, like only those reputed top rated corporates are allowed to be participant in money market, so they should have that much money with themselves. Okay, then money market mutual fund. Money market mutual fund, launched in 1992, provide investor with a safe and liquid investment option, could offer better return than traditional saving account. Okay, simple thing. When it was introduced in 1992, there was not much, there was not much publicity about it. People were not aware about it. That's why it was called money market mutual fund. So they in this mutual fund, money market mutual fund activities, people can invest in short-term debt securities like certificate of deposit, commercial paper, or treasury bill. So they have different option. I have already explained in previous slides. Okay. Then this one, bills of exchange, I have already explained you. Okay, just giving a quick recap, that it is a written order used by companies for short-term borrowing or payment. Okay, that if I want to pay after 2 months to that person with whom I have purchased some goods, then I can issue some bills of exchange. Okay, written order issued by companies for trade transaction. Then hundi. Hundi, it has came in PYQ, that's why it is important. Hundi means informal traditional form of credit used for short-term financing in trade. So if you are doing short-term financing for trade purposes, then it is called hundi, used in informal market, especially in India. During ancient times, they for short-term financing during trade, there was a group of people who used to issue some money, who used to do bills of exchange, and that bills of exchange was known as hundi in previous times. Okay, then comes commercial paper. I already told, issued by corporate, short-term unsecured debt instrument issued by companies to meet their immediate funding needs, should be lesser than 1 year, because we are talking about money market, so each of these instruments will be for below 1 year only. Okay, then comes promissory note. It is a written promise by the company to pay a specific amount at a specified time. Again, that company is promising that I'll be paying this much after this point of time. Okay, then comes merchant commercial bill, a bill used by merchant to finance trade transaction. Okay, commercial bill I have already explained. So this kind of I would request to watch previous one. Issued by trade financing, same thing. Call money, interest rate for overnight borrowing between financial intermediaries, banks and non-banks, used for borrowing for a single day. Okay, notice money for 2 to 14 days, CBLO, collateralized borrowing and lending obligation, an instrument for short-term loan backed by collateral managed by Clearing Corporation of India. Okay, so if any kind of loan is backed by some sort of collateral, it will come under CBLO. Simple thing, नाम से ही पता चल रहा है, collateralized borrowing. Simple, okay. Then ICD, intercorporate deposits, unsecured short-term loan given by company to another company, short-term loan between the companies. Okay, so unsecured loan one company is giving to another one. Intercorporate deposit, नाम से पता चल रहा है intercorporate है ये. Okay, then repo and reverse repo, short-term borrowing lending agreement where securities are exchanged for cash. Securities are exchanged for cash at a discounted price. Okay, then tri-party repo, when there is a third party, third agent who is being intermediary between one person to another to do such repo transaction, then it is called tri-party repo. Okay. So I have already discussed too many things in money market. Just hold it here and please try to revise your notes once. Okay. And then now from now onwards, I'll be discussing capital market. Okay. So, capital market are of two types broadly. First is institutional financing, securities market. Capital market simply that you are taking a borrowing a money from market, from banks, from different sources for a longer period of time. For money market, within a year, shorter period. Capital market, more than a year, longer period. Okay. So first is institutional financing, second is securities market. So institutional financing means you are you are taking loan from any particular institution, Exim Bank, IDBI, LIC, something. There are different firms, and you are taking from any particular institution, borrowing money from particular institution. Okay. Then comes securities market. Just a second. Let me clear this. Securities market. Okay, so in this market long-term capital is raised via shares, bonds and debenture. Okay, long-term capital is raised via shares, bonds and debenture. Okay, so shares, equity, I have already explained. Shares, ownership, right? Ownership, bonds and debenture. I think I have provided somewhere the difference between two. Let me see. I should have added here in the beginning only. Where is it? Okay. This one, bonds and debentures. So I hope that you are already aware about the meaning of shares or equity. That means you are getting ownership in your company, in that particular corporate. You have a voting right. You have a share from profit. All those things. But there is a bonds and debenture as well. And in this particular session, you will be hearing again and again this bonds and debenture. So even as a teacher, even or even students, as a students, I know how much is being confused. Like I used to be confused कि ये दोनों तो same ही होता है. Why we are calling at one point of time it is bond, at one another point of time debenture? Why? So just try to understand it. Just a minute difference, that bonds are debt instrument with asset backing and debenture are the bond instrument without asset backing. Simple. Bonds are secured loan. Secured loan. Debenture are unsecured loan. Okay. Bonds have a low because it has a asset banking, it has a lesser risk as compared to debenture. So interest rate given on bonds is also lesser than debenture. Okay, so it is understood. So interest rate is lower, interest rate offered on bond is lower than the debenture. Sorry. Then convertibility. Bonds are non-convertible. If you have opted for bond to purchase bond of any particular company, you cannot go for ask for ki convert this into equity shareholding for that company. But in debenture you can do, you have that option. If you have that condition in your agreement, then it can be convertible as well. You can convert those debenture into equity shareholding as well. Okay. Then in bonds, higher in case of liquidation, and higher priority is given to bonds. Suppose that company is become insolvent, and they are just going to be liquefied, they are going to be shut down. So creditors are the person who used to get money on the very first run. So between debenture and bonds, bond holder will be getting money earlier than debenture. Okay. After paying to bondholders, then there will be payment to debentures. Okay. So bondholder will be getting priority on debenture. So I hope that you have understood the difference between bonds and debenture as well, and you are aware about the meaning of equity shareholding as well. Okay. So I was at this position. So in securities market, government security market, and then corporate security market. Okay. In government security market, again, both are of two types, primary and secondary. Corporate security market, again, primary and secondary. Simple difference is that in government security market, government used to issue government securities, and this GSEC are being sale and purchase into second capital market is also known as secondary market. So these government securities are being traded in secondary market. In corporate security market, corporate used to issue security. Simple. This is the simple thing. Okay. So there are three instruments here: share, bonds, and debenture. I hope you are aware about it. Now comes this government securities. So I have already explained this part before, that in primary market, in money market is also known as primary market. Okay. So in money market, RBI used to issue some government bonds, government securities at a discounted price. Okay. This has been discussed in the previous slide. Then and this securities, because if it is lesser than 1 year, then that is, sorry, you cannot call it money market, because money market is for 1 year only. If you are issuing government securities at for more than a year, then it will be doing under, like, coming under primary market. So primary market have a overlapping thing. Primary market can contain money market as well as capital market. When those government securities are being issued for less than a year, then it is money market. But if those government securities are issued for more than a year, then it is capital market. Okay. So I hope that primary market and secondary market, you are aware about the difference. Primary market is the issuer, is the place where government those securities are being issued. And secondary market, when those issued securities are being traded. Okay. So that is called secondary market. Okay. So in government securities, RBI used to issue government securities at a discounted price in primary market. Again, I hope that you are aware about the discounted price method, that the face value of share is 1 lakh and they are being issued at 90,000. Okay. So if it is for more than a year, it is for capital market instrument, it is known as government securities. But again, these government securities are of two kind, like issue mechanism is are of two types. First is bonds, second is zero coupon bond. Okay. First I'll be discussing about bond, then I'll be explaining about zero coupon. Again, it is very important and conceptual as well, so please try to focus on it. When securities are issued uh, uh, based on an interest rate, like if government is issuing 100 rupees worth of government bond, and they are saying that after a year, in a year I'll be like government will be paying 5% interest on it, then it is called bond, government securities. And this interest rate are known as coupon. So in when government is paying some sort of interest rate, we call it coupon rate. What? Coupon rate. Okay. So if there is a coupon rate or if there is an interest rate, both are same when government is issuing those kind of securities. Okay. So they used to pay periodic interest, that is coupon, and return the principal at maturity. Okay. And it is also known as gilt edge security. Gilt edge security, why? Because they are having the highest quality, I mean safest option. If I am purchasing government bonds, I can be assured that my money is not going to be sunk or go run away. Like it is not going to be vanished, I'll be getting return for sure. So government securities are the safest option, and that's why they are known as gilt edge securities. Okay, so first method is this. Then second is zero coupon bond. Zero coupon bond means discounting price पे issue करना. Okay, simple, similar to this one. That zero coupon bond are bond that do not pay periodic interest. Instead, they are sold at a discount to their face value, and the difference between the purchase price and the face value is the return to investor. Okay, so purchase price, suppose there is 100 rupees worth of bond and government has issued at 95 rupees, and they are saying that after a year, once you sell me this bond back, I'll be paying you 1000 105, sorry, 100 rupees only. Okay, so in this process I'll be getting 5 rupees after a year. Okay, so that is called zero coupon bond. Same thing have written here, like zero face value of any bond is same for both securities, zero coupon bond and gilt edge security 10,000. But in zero coupon bond, discounted price will be 9.5, I mean 9,500. And then they are not getting any coupon rate because they will be getting 500 at the end of maturity period, and they will be getting 10,000 back. Here they will be getting 5% interest on it, on this 10,000. Okay, then comes yield and bond price. I have already explained in detail and in very comprehensive manner in the previous session. So I would request you to please watch that. For now, just I am just giving you the factual aspect, what you need to remember, because the conceptual one I have already explained. Okay. There is an inverse relation between bond price and yield. So when bond price increases, yield yield, that means profit on bond, decreases. Okay, when bond price decreases, yield increases. Simple. Okay, when bond price increases, interest rate decreases. When bond price decreases, interest rate increases. So in short, if you want to remember this aspect, why is it happen, I would again request you again and again that please watch the previous session. I have already explained the relationship between why the bond price increases, then it leads to decrease in bond yield. Okay, so again there is an inverse relation between price and yield. Okay, and price and interest rate. Okay, so this is the factual thing you need to remember. Why? Suppose there is a 10-year bond, there is a coupon rate of 5%, government is paying 5% interest on it yearly. So suppose price of government bond decreases to 9,000. Okay, so earlier yield was 5%, but after this they will be getting 5.5%. So you can see when price reduces, yield increased. That means interest rate increased. Okay, when price become 15,000, that means price increase, then yield reduces or interest rate reduces. Okay, similarly when price decreases to larger extent, you can see that yield increases to the larger extent. Okay, so the same thing. This question might directly ask, it is highly relevant from a prelims point of view. Okay, then types of capital market. Again, based on issuance, I have already explained the primary and secondary market in the beginning only, because this slide could have been earlier than the previous two slides, because I have already explained the primary market and secondary one. Primary market, where new securities are issued for the first time by companies, and here fresh public offering or initial public offering used to be done. Okay, in then secondary market, resale of securities facilitate trading of previously issued securities between investors. So that is stock and bonds and all these things happens here. Okay, stock exchange like New York Stock Exchange, London Stock Exchange, something like that. Okay, so from this picture as well, you can see that in primary market, there is a direct link between company and the person who is purchasing it. But in secondary market, one person is selling to another person based on demand and supply. And what they are trading the securities of this particular institution who have issued it. Okay. Then based on instrument types. Okay. So capital market for based on the issuance, based on issuance there are two types, primary and secondary, but based on instrument type, which kind of instrument we are trading in capital market, they are of three types. First is forex market, second is derivative, third is commodity market. So in forex market, currency is being traded. So even in today's news, our $1 is equal to 87 rupee right now. So our currency is being depreciated on a larger scale. They are in depreciation mode right now. Why? Because there is a lesser demand for Indian rupee and higher demand for US dollar. So where we are, how we are deciding it? Is there any God entity who is announcing it on daily basis? No, it happens in forex market. Okay, so here when there is a currency trading, when there is a high demand for any particular currency, their value goes up, and when there is a lower demand for particular currency, their value goes down. And that's why when there is a higher FPI inflow, that happens in recent scenario, there was a huge outflow of capital from Indian stock market. So that what was happening there, there was increase in dollars demand and decrease in rupee demand, and that's why our rupee got depreciation. Okay, so right now our rupee value is depreciated to the larger extent. So that happens in forex market. Okay, then comes derivative market, deals with contracts based on underlying asset like stock, commodities, or indices. Okay, it depends upon the contract, future options, swaps, something like agreement that if this happen, then you'll be paying me this much. So something like that, dependent on something. Okay, then NSE's Nifty future commodity option, something like that. Then comes commodity market, commodities. Commodity market, trade in raw material or primary product, gold, crude oil, agricultural goods. So that happens here. So again, there is a separate platform for commodity market as well. People used to buy and sell based on the depend upon scenario, and their company who are registered on commodity market used to get money, but in tangible form they used to trade in raw material or primary product. Okay, so derivative market are of different types: stock, bonds, currencies, commodities, market indices, interest rates. So they are like derivative market, they used to generate money or generate profit on behalf of these things. So they can be dependent on multiple things. Okay, then comes market and products for trading. Okay, so in financial market, stock, I hope that you are already aware that product includes stock, ETF, REITs. Stocks of each country are traded on their own centralized exchange. Every country have their own centralized exchange, not currency exchange, but centralized platform. And not even centralized. This is central, decentralized as well, but there is some sort of regulator. So in Indian stock market, there is a Sensex, there is a Nifty. So who used to regulate it? SEBI. Okay, then bonds I have already explained, mostly between financial institution on decentralized OTC market, small number of bonds listed on exchange. Okay, that is a factual aspect, you can ignore it, but just try to understand the meaning. What is stock, what is bond, what is commodities? Product include physical trading as well as derivative, bulk or transaction. ETF or ETC, exchange traded commodities, were added in 2003. Okay, then forex I have already explained. Then crypto, now there is another platform where cryptocurrency trading is going on. So it again, value of crypto depends upon demand and supply it have. So exchange allow customer to trade cryptocurrencies for other assets such as conventional fiat money, or to trade between different digital currencies. Then comes derivatives. Price of derivatives are derived from price of other product include forward, future, CFD options, different things. All things I have already explained in the previous slides, but just it was just a quick recap, and I even you can just skip it. Okay, then comes debt instrument. Okay, debt instrument are of different types. Debt instrument: simple, loan, loan instrument, just a second, loan. Okay, so in money market, You have promissory notes, you have treasury bills, certificate of deposit, commercial paper, repurchase agreement. In bond, long term, for short term, money market instrument, for long term, bonds and debenture. Everything I have explained already. So no need of repetition here. Okay, so debt instrument is a financial asset that represent a loan made by investor to a borrower, typically a corporation or government. Okay, simple thing, no need to pay, do something large. Short-term debt securities for less than a year, it's sold at a discount and repurchased at face value. The difference in investors' interest, rediscounting, money market, near money. These assets are short-term, especially this one, money market instrument. They are called near money. This is important. These assets are highly liquid and can quickly be converted into cash. That's why they are called near money. Okay. Then long-term securities, long-term debt instrument. Okay, so first is coupon bond. Coupon bond means, again, coupon bond. If it was a zero coupon bond, then that bond have issued at discounted price. But it is a coupon bond. That means bond will be getting some sort of coupon rate. That means interest rate. Okay, each year or based on some periodic interval. Okay, so bonds with detachable coupon used to claim interest from the issuer. The interest rate is called coupon rate. Same thing I have already explained in the previous one. Okay, then zero coupon bond, again I have explained already. Bond sold at discount and redeemed at full face value later without paying regular interest rate, often used for special initiative like social stock exchange. Okay, then bearer bond. See, whenever any kind of bond is being issued, then if I am purchasing it in a primary market, my name will be registered in that primary market. Okay, so that will be done. But in bearer bond, what happens is that is not having any registered owner. Just a second. Sorry. Huh. So bearer bond is not having any kind of registered owner. They what whoever is taking that bond, they will be liable to claim that interest from the company itself. Okay, so it is not linked to any personal ID. Anyone holding the bond can claim interest or repayment, commonly used during wartime but less secure. Okay, whoever that bond, they can claim that. Government securities, gilt-edged securities, again, already explained, no need to go into in repeating mode. Then comes ways and means advance. Okay, just a second. Okay. See, uh, RBI used to give money to uh, government, okay, many a times. But again, I'll be repeating the same thing as per the FRBM Act. I'll be explaining this in public finance chapter, but just for now, just for giving you the glimpse that as per FRBM Act, RBI is not allowed to print currency and to give to RBI, give to central government. Okay, so when this was banned in FRBM Act, they came up with different mechanism, that is ways and means advance. That government asked the committee that if you are banning this, how we will be managing our funds for short term needs. Then they said that you should follow ways and means advance. That means for temporary time you can get some money from RBI. Okay, it will be like a loan, short term loan. Okay, so to central government, the limit and period for this one, WMA, first understand this. This is used when government experiences a short-term mismatch between its income and expenditure. Okay, RBI provides short-term loan, usually up to 3 months. This is important to bridge this gap. So ways and means advance is not being used for a longer term or for larger projects. No, if they have some temporary mismatch in their revenue and expenditure, then only they can go for ways and means advance. Okay, and RBI used to give for 3 months. The amounts borrowed under WMA are not counted in the fiscal deficit figure. Again, because it's for short term only. For after 3 months, they will have to pay it back to RBI. Okay, so that's why it is not recorded under fiscal deficit. This is also one of the important thing, and you can go for logic as well. Then during the corona crisis, there was an increased mismatch in cash flow, leading to Atmanirbhar Bharat initiative in 2022, where RBI raised WMA limit to assist both union and state government. And in WMA, both central government and state government both are allowed for this. Okay, state government both are allowed for this. Okay. Then in 2024, RBI again raised this limit. However, the specific figures are not important. Same thing, leave. Okay, so I hope that you are aware about the meaning of ways and means advance. That means short-term temporary needs, and to manage the mismatch between revenue and expenditure of their cash flow. Okay, so central government limit and period of WMO is decided by central government in consultation with RBI. For state, limit varies for state depending upon the economic size of a state. Okay, and the interest rate in WMA is same as repo rate till 90 days and repo plus 1% after that, because it is for 3 months majorly. But if you are increasing it for larger time, for suppose 4 months or 5 months, then you have to pay penalty charge as well. So repo plus 1%. Okay. Under bank, when they were taking more money after repo limitation, when they were borrowing more money, then they have to pay MSF, marginal standing facility. Okay, so similarly here also, like, they have to pay some penalty rate, repo plus 1. Okay, and for state government, it is for central government. Okay, for state government, allowing for maximum 14 consecutive working days, so they are not even allowed for more than 3 months. Okay, central government can go for more than 3 months, but with some extra penalty charges. But state government is not allowed for that. They are only for maximum 14 days consecutive working days after 3 months period. Okay, uh, then allowed for maximum 10 consecutive working days after this period. After again, okay, then comes, this is the committee name. Either you just have a glimpse that BPR Vithal committee, C Ramachandra committee, then Vizura committee, then Sumit Bose committee, all were related to WMA, but that's okay. You can skip it as well. Then comes special drawing facility. Special drawing facility means when state government have utilized their WMA means. WMA ways and means advance method, state government have already utilized that, but they are needing more money, then they can avail this mechanism as well, that they can ask for money from RBI under special drawing facility. It was started in 2013. It is a nomenclature of special WMA was changed to special drawing facilities since June 23, 2014 by amending the respective government with state government. Okay, by RBI to states a short-term loan against the union government securities treasury bill as collateral. So whenever state are doing this, because they have already utilized WMA method, then they have to give some government securities or treasury bills as security. Okay, and they have to give it as collateral. Okay, so debt instrument by government, because it is for earlier, before WMA, I was talking about the debt instrument of market of all players. But right now we are discussing just for government, how you government used to match their needs in temporary period, for temporary period or for longer period. Okay, so for short term period, union government can go for treasury bills. Okay, 14 days for cash management bills, up to 91 days, if you say up to 91 days, then treasury bill for 91 days, 180 to 364 days. State government are not allowed for issuing treasury bills. Okay, so this is important to learn. State government are not allowed. Okay, then cash management bills available up to 91 days, state government again not allowed. Okay, so state government cannot go for short term borrowing. That is also under treasury bill and CBM, cash management bill. Why? Because in this one, central government is borrowing from market, but state government is not allowed to do that, to borrow from market. Okay, this is the one important aspect here. You need to write it down if you will, if you think that you'll forget. Okay, union government is allowed for taking money for taking borrowing money in money market from market external sources. Okay, then there is a ways and means advance and special drawing facility as well. So this is available for both central and union government. Why? Because they are getting this temporary mismatch from RBI. They are fulfilling it from RBI. Okay. Then for long term, government securities can be issued by union government, and if state government are needing some long term loan, they used to issue state developmental loans, SDL bonds. Okay, simple to government bonds, but it is called state development loans because it is generally for higher time, 40 years, 50 years, and it is for development purpose of state, so they named it state developmental loans. Okay, so I hope that you are clear about this, all these information here, because they are highly relevant and important to understand as well as to learn. Okay. Then short-term loans for government as well. So again, these are the factual aspect for WMA. There is a repo rate after for union government. What I'm saying, uh, for union government, they used to charge repo plus 1 if they are exceeding the limit, that is 3 months, and state government is not allowed to exceed that limit as well. Okay, and for loan quota is also there, that they cannot avail a lot of money under WMA. If they are saying that we need 1 lakh crore, then it is not going to happen for states. So they have a limitation that they can they can borrow up to 60,118 crore from RBI under WMA. Okay, and if they exceed it, they can go for SDF, special drawing facility. Okay, depends upon how much collateral securities they have, and they can pledge to RBI, and they can get some money at a discounting rate. And here they will get not a discounting per se, but they will be getting at a repo minus 1% rate. Okay, for loan quota for union, they can get under WMA up to 1.20 lakh crore of amount from WMA, and it is used by union when WMA quota is over. Okay, overdraft. Okay, and then SDF facility is not available for union because union government securities is already off for central government, so they can issue more and more government securities and go for this SDF facility. So that is not possible, that is not allowed to them, SDF. Okay, overdraft is allowed for both state and union, but again, once they finish their quota under WMO and WMA and SDF, then they have to pay extra charges here again, because this is a kind of penalty charges, is the second penalty charges. Okay, then repo plus 2 to 5% of extra charges they have to pay. Then comes factoring. Factoring is similar to bills of exchange, what I was explaining before. Okay, again, it is to solve problem of MSMEs because they are lacking money. They cannot, when they are not getting money at one point of time, whenever they need, then they can show those bills of exchange to banks and say that, look, you can get this money from that vendor, just pay me some amount at a discounted price. Okay, so factoring is a financial service where business sell their account receivable invoices to third party known as factor at a discounting rate. Okay, so here the third party cannot necessarily be a bank, but any institution allowed by RBI. Okay, so there is a seller, there is a buyer, there is a factoring, I mean factoring institution. Okay, so they pay 80% of the invoice value immediately to seller, and rest 20% they are earning while chasing the borrower for payment. Okay, so how it is different from bill discounting, what we have explained before, commercial bills. Okay, then in bill discounting or commercial bills, businesses are responsible for collecting the receivable. Okay, so if one point of time, if a buyer is not paying that 100 rupee to that factoring is that bank, then seller is responsible to pay it back. That institution will go to seller and they say that this person is not paying, you pay me 100 rupees. But here buyer and this relationship will hold between factor and buyer. So if buyer is not paying it back, then factor factoring institution cannot go to seller that this person is not paying, you pay me right now, because that seller has already sold that one to factor. Okay, so collecting receivable thus assumes the risk of non-payment. So in factoring, this is a kind of non-payment. So factoring is largely for those MSMEs who are selling up their raw material or their input to their output to bigger institution like Reliance. Okay, so if there are some bills of exchange of Reliance, then any institution per se, for me, that I am looking that Reliance will not go away, they will pay anyhow. So I will be the become the factoring institution here, and I'll purchase at a discounted price, and then I'll get that money from them. Okay. So this is the difference, major difference between commercial bill or bill discount and factoring. Okay. Then there was a regulation in factoring amendment act in 2021. It was, again, this amendment came to solve MSME problem. Okay, so I'll be discussing this changed norms only because this is not important for now. Okay, so eligibility to lend. So who can do factoring and all? So the major difference was that they have added most of the NBFCs. So banks and over 1000 NBFCs are allowed to do factoring activity. So after RBI registration, but again, RBI registration is important. Without getting license, how can you do that? So with after RBI registration, all NBFCs and banks are allowed. Okay. Then loan availability, increased loan availability for MSME with more lender entering the market. Then RBI's regulatory power, expanded power for RBI to oversee and regulate the factoring business. Then trades legal clarity, clear legal framework provided improving transparency and efficiency. Okay, legal framework. Then fraud prevention, mandatory registration of invoice-based loan on a central registry under the SARFAESI Act. Okay, the streamlined regulatory environment make factoring more accessible and secure, benefiting MSME significantly. Simple thing hai, you just need to understand what is factoring and who is allowed. So in questions they might ask that they may say that factoring means, and they will be giving different options. So you should be understanding that what it means actually. Okay, next they can ask the difference between commercial bills and factoring, which is also important to understand. And next thing they can ask that who are eligible to participate in factoring process. So then you need to learn that banks and NBFCs are allowed into it. Okay, that's it. Then comes trade receivable discounting system. Trade receivable discounting system is an online platform that connects the factor, banks, NBFCs with the borrower, MSME and export. Okay, so same thing. See, I am a seller. I have some bills of exchange from bigger institution, renowned institution, but I need liquidity right now. So where I'll go? So I'll go this trades electronic discounting system platform. So it is developed by government itself. Again, this was in news only. That's why factoring was also in news last year and last to last year again. Okay, so this is an online platform which collaborate and connect the factor institution, that is bank or NBFC, with the borrower, MSME or exporter, whoever need liquidity. Okay, some famous trades platform are M1 Exchange, RXIL, and then A Trades. They have to register with RBI. Simple. Okay, then what is inflation index bond? See, we there are so many terminologies to understand in this session, but you need to understand it because, again, if you understand it, you will be not needing to remember so many facts. But if you don't, then you have to remember. So there is no other way out. Okay. So inflation index bond. Simple, by name, inflation adjusted bonds. Okay, you have a two option. Through this, you can easily understand the whole scenario. You have a two option. You have a bond purchase without inflation adjustment, and another one you have purchased the bond with inflation adjustment. Okay, so suppose you have purchased bond worth of 1 lakh rupees. Okay, you will be getting nominal interest rate of 6%, and there is an inflation of 5% in the economy, 5% as a overall existence of inflation at the rate of 5% current in economy. So real interest rate, I hope that you know the difference between real and nominal. So real interest rate means nominal minus inflation. So 1% will be your real interest rate, what you will be getting after a year. Okay, because 5% of inflation, 5% whatever you are getting, it will be deducted as a inflation. Okay, then adjusted inflation amount is 1 lakh same, because there is no deduction of inflation adjustment. Then what you are earning, interest earned is 6,000. Why? Because you are getting 6% interest rate, no? So you will be getting at the end of the year is 1 lakh 6,000. Actual earning will be 1,000 only. Why? Because 1 lakh 5,000 will be the value of your investment after a year. Okay, so 1 lakh 6,000 is your earning. But at the same time, if you have inflation adjusted bond, then what happens? You are getting 6% interest, same. There is a 5% inflation as well. Okay, so real interest rate is adjusted for inflation. Again, 1% will be there. Okay, that's okay. Then inflation adjusted principal amount. So you know that there is a 5% of inflation adjustment in a year in that economy, then your value of your investment will be 1 lakh 5,000 by 5% for inflation. So your principal amount is 1 lakh 5,000. Okay. Then you'll be getting 5% interest on this 1 lakh 5,000. So interest earned is 6,300. 6% of 1 lakh 5,000. Okay, 6,300 you'll be getting as an interest. Then what is your principal amount? Your adjusted principal amount is 1 lakh 5,000 plus interest you have got 6,300. Then your total investment earning would be 1 lakh 11,300. So you see that in inflation index bond, your earning is higher as compared to without inflation adjusted bond. Okay. So an inflation index bond by RBI is saving instrument where returns are linked to inflation, ensuring the principal and interest maintain real value despite rising prices. This is simple. Okay, inflation has been adjusted in your earning, and then you are getting return based on that. Then comes RBI SGB scheme, I mean sovereign gold bond. Gold bond is simple. If you break this word, you'll be getting the essence of this terms. Okay, sovereign gold bond. Sovereign means issued by bank, not bank, issued by government. That's why it is known as sovereign. Okay, then gold bond. That means loan on behalf of gold. Okay, gold bond. So on behalf of government of India, RBI issues, again, who issues it? RBI used to issue on behalf of government of India. This bond are denominated in grams of gold but do not promise physical gold. They say, like, suppose if I have purchased gold bond, that means if I have purchased a gold bond, that means I will be getting some sort of money as per the gold value, but not in physical form. I'll be getting money. Okay, so suppose I have 100 rupees, I have a two option. Either I can purchase some sort of necklace, gold earrings, gold, something related to that. What traditional India used to do. Second is that I used to invest in sovereign gold bond, and I'll be getting some sort of interest based on the value of gold existence. So in this one, in the second one, the demand for actual physical gold will be lesser, and in the first one, demand for physical gold is higher. And because gold is not being produced or being not being mined in India, there is a limited availability. So when we are demanding more physical gold, that means we are importing more gold. That means there is a current account deficit because of this. So to solve this, RBI and government thought that we should issue government a sovereign gold bond. In that way possible, we will be able to reduce our gold import quantity. Because for me, I am not very much fond of gold necklace, gold jewelry. Then what I'll do as a safer investment option, I'll be purchasing the sovereign gold bond. Okay, so slowly and steadily there will be a lesser demand for physical gold. Okay, the simple reason behind issuing sovereign gold bond is this. Instead, on maturity, the investor receives the equivalent value in rupee based on prevailing gold price. Okay, so when it was issued, it was issued in 2022, and issue prices was 4,786 gram, and discounted offered by RBI was 50 rupees per gram. Okay, and then minimum investment, like if I want to invest, I have to purchase at least 1 gram of sovereign gold bond, and then maximum investment can be for 4 kg if I am an individual or Hindu undivided family, and it is for 20 kg if I am a trustees or other bigger institution. So there is a minimum limit or maximum limit is also there for any participants in sovereign gold bond scheme. Okay, and tenure for this bond is 8 year, and exit option is for 5th year. So if I have purchased the sovereign gold bond for 5 year, I cannot sell it. Okay, I mean, on secondary market I can sell it, but I can not redeem it. I cannot ask for a RBI ki you give me money back. I want to redeem it. I can't do that up to 5 year. After 5 year, I can do that, and this bond is worth of 8 year, like tenure. So key feature interest rate 2.5 to 2.75% interest rate. Not much, safer investment but lower interest. Okay, tenure 8 years. Then investors eligibility Indian resident, including individual, HUF, trustees, universities, charitable institutions. So you can see that there are some specific investors. So if there is some extraordinary options in your questions, that like NRIs, then some foreign banks, then you can say that no, they are not allowed. Okay, only Indian resident, individual, HUF, trustee, universities, or charitable institution are allowed in it. Purchase limit again 1 gram to 20 kg, depending upon the who you are. Okay. SGB helped to reduce the demand for physical gold import by offering a secure alternative that turns portion of domestic saving typically spent on gold into financial investment. So I hope you are aware about it. Then what is junk bond? Junk bond, simple, that my company is not doing good. My reputation, my goodwill in the market is not good. So whenever I issue bond, there is a lesser demand for that bond, because again the probability of getting bankrupt or probability of not paying that bond return is higher for my company, because my company is not doing well. So in that sense, those bond issued by these kind of companies are known as junk bond. Okay, so junk bond, if issued by companies that are new to the market, struggling financially, to have a poor credit rating. So there are poor credit rating. So rated, so when they have a poor credit rating, for example, B to D, there is a credit rating agency. They used to get A plus, B double B, something like that. So rated BBB or lower, S&P or Fitch, rated BAA or lower, Moody's. So there is specific thing. If you are belonging to this category of companies, and then if you are issuing, those bonds are known as junk bond. It indicate economic health or and investors willingness to take risk. So they have a higher default risk because they are struggling financially, and they, but so then if they have a higher default risk, why anyone purchase those bonds? Only because they are offering higher interest rate, because there is a higher risk involved. So if they are offering higher interest rate, then only I'll go for to purchase those bonds. Then higher volatility as well, higher yield as well, because higher interest means higher yield. Okay, if company has a higher risk of default, credit rating agency grade it bonds as a junk bond. Such companies must offer very high interest rate to attract buyer. Simple. Then comes redeemable versus irredeemable bond. Simple नाम से समझो, redeemable, which can be redeemed. I mean, if I have purchased bond after some period of time, I can go and demand my principal back. But in irredeemable bond, I cannot demand my principal amount back. Simple. Okay. I'll be getting interest infinitely or till the limited period of time, depends upon the agreement I have done. So redeemable bond, pay regular interest and return the principal on maturity. This is important. Whereas irredeemable bond pay only interest with no principal repayment. However, some like AT1 bonds used by bank for Basel requirement may allow redemption after 5 to 10 years. So mostly are irredeemable, matlab they don't return principal repayment, like AT1 bonds. If you see AT1 bonds, banks used to pay interest for infinite time, but if they want, it depends on their discretion, that if they want, they can redeem it after some period of time. Although if they don't, then they that purchaser cannot go to that bank or that institution to demand for principal amount. Okay. So redeemable debenture are issued at a fixed period. Principal amount of such debenture is paid off to the debenture holder on expiry of such period. Such debenture can be redeemed by annual drawing or purchasing from the open market. Then non-redeemable debenture. Debenture which are not redeemed in real life of the real lifetime of a company. Such debenture are paid back only when the company goes into liquidation. And even if, like, in some case, in some scenario like AT1 bonds, they can nullify those bonds on behalf of their discretion as well. So that happens. But in most cases, if company is going in insolvency process or liquidation process, then they redeem those debentures. Okay. Then hybrid financing, mezzanine financing, same thing. What I was saying, that when you are taking a debt instrument, bonds or debenture especially, not bonds, if you are taking a debenture and you are saying that after this period of time you will be converted into shareholder of a company, then it is a kind of hybrid financing. That means I am giving you the offer to be a creditor in the first hand, and then become a shareholder in my company. Okay. So when it happens, simple socho, Shark Tank, you must have seen the episode of Shark Tanks. You have seen that when investors are saying that, look, I'll be giving you 40 lakhs at the rate of 12% per annum, and after 6 years I want a 3% equity in your company if you reach to this much level. Means that until I am not getting sure that your company will be having growth in future, I'll be giving you a loan and I want a fixed return. Okay. But when I see that your company is having higher growth, you have a scalability for potential growth, then I will demand for shareholding, that after a period of time I want a shareholding in a company, and whatever the profit you are getting, I want that portion. Okay. So that is called hybrid financing, or we also call mezzanine financing. So here, convertible option, the lender can choose to convert their loan into shares, equity of the company. This is done using tools like optionally fully convertible debenture, that fully convertible or partial convertible debenture depends. Okay. Common use, venture capitalists often use such instrument when investing in startups. It allows them to earn fixed return initially and later benefit from ownership if companies grows. Comparison of investment instrument. Okay. So return, if you see that in normal bond there is a fixed return of 12%, in optionally fully convertible debenture there is a return of moderate 8%, in shares there is a return of uncertain return, because it depends upon your profit. Okay. So see, if we take debenture, normal non-convertible debenture here, because there is a non-convertible debenture topic in coming slide, but right now, if there is a debenture which cannot be uh, converted into equity, first option, then there is a bond, or again NCD, there is a optionally fully convertible debenture, and then is a share. Then the risk is very high in non-convertible debenture. Okay. So they will be getting preference when company is going into the liquidation process, and they will be getting higher interest rate more than those as well. So they, again, this one is fixed for 12% for NCD as well. Okay. But OFCD is not being that much riskier, because in case of a company is not a company is getting growth, they can convert it into shareholders as well. Okay. So they have a high um, potential to earn from that company. So they are offering lesser interest rate, and share, again, if they are having profit, they will be getting share. Okay. Then again, because they are having a high risk, they will be getting priority for the first claim. Then they have a medium priority, and then shareholder will be having last or residual claim. Okay. Then comes bonds and debenture. I have already explained, that's okay. Then comes difference between the bonds and non-convertible bonds and debenture. The same thing, that bonds can be not bonds, but if debenture, if you want to use debenture, they can be converted into equity shareholding, but non-convertible debentures cannot be converted into equity shareholding. This is the simple thing. Okay, they cannot be converted into share of the issuing company. That is the only thing you need to understand. Rest you can leave. Then comes foreign currency convertible bonds. Okay, foreign currency are bonds subscribed by non-resident in a foreign currency, carry fixed interest rate and option of convertibility. Interest is paid in dollar and redemption is also in dollar. Interest is low, but exchange rate is more. Simple है, foreign currency convertible bonds. Okay, those are subscribed by NRIs. Simple. Those bonds are subscribed by NRIs. They are called foreign currency convertible bond. That means they can be converted into foreign currency as well. So they also carry fixed interest rate, and they have the option of convertibility because it is already written in this word. Okay, and interest is paid in dollar and redemption is also in dollar. Interest is low, but exchange risk is more. Exchange is because the value of dollar with respect to rupee can be go up and down. Okay, so FCCB are bond issued by the companies in foreign currency offering fixed interest rate. Same thing, issued in foreign currency. Okay, fixed interest rate and conversion option, lower interest rate than non-convertible bonds because investor get the bonus of conversion option. Okay. Then comes contingent convertible bond. Okay, contingent convertible bond means simply convertible hai. Okay, convertible bond. I hope that you have understood the meaning of convertible bond. That means you can change your debenture to equity. But in contingent convertible bond, there is kind of obligation. Okay, that after this period, after 3 years, after 4 years, this bond will be converted into equity shareholding. I mean, this debenture will be converted into equity shareholding. Okay, so there is a obligation that it has been written in agreement only that after a specific period it will be changed. So that's why the contingent word is added in the beginning. Contingent. Okay, so it will be converted into equity after some point of time, and I or it will be write off, but it is generally not for write off. They are converted into, see, the difference between convertible and contingent, you can say that convertible, if being a company owner, I don't want to convert my debentures into equity, then I will be paying them back. But if there is some sort of agreement of contingent convertible bond, then even if I don't want to give share to them, but still I will be giving some sort of shares because it is being automatically converted into equity share. I do not have specific power into it until it is written in that agreement that I can do this or that. Okay. Then there are so many other kinds of bond as well. So first is BRICS bond. It was issued in 2014 by New Development Bank of BRICS, and it was denominated in US dollar. Okay. Then World Bank's blockchain bond. It was issued in 2018, and again, world's first blockchain debt instrument using Ethereum blockchain technology, sold in Australia within 2-year tenure and 2% interest rate. Okay, there is a masala bond as well. Masala bond is rupee denominated bond. Rupee denominated means whatever the bond, if someone is purchasing masala bond at international level, that means they are increasing demand for rupee in forex market. So that will uplift value of rupee. So what are they? Rupee denominated bond issued outside India to raise fund for Indian companies. So Indian company can raise fund through this. And who started it? International Finance Corporation launched to support Indian companies. Okay. Key milestone in this one is in 2015, RBI allowed Indian entities to issue masala bond. So probably they might ask what is masala bond. So you can learn, you can understand that Indian companies, if they want to borrow from international market, they can issue this masala bond. Okay, in 2017 NHAI issued masala bond on the London Stock Exchange for highway project. In 2019 Kerala became the first Indian state to issue masala bond, raising 21 billion via KIF, 9.7 interest due to BB credit rating. Then there are other kinds of bond as well. Panda bond. It it was issued in China, but not by Chinese company, but a non-Chinese entity in China, denominated in renminbi. Same dim sum bond, kangaroo bond, Maharaja bond, masala bond, Formosa bond. You just have a glimpse, nothing else to remember here. Okay. Then comes surety bond. Okay, let me see. I think there is a significant amount of subject are still left to be discussed. Okay, so I think we have already discussed a lot for one session, and it's been too much to give so much information to you in a one session. So I'll be summing up it here right now. I'll be discussing rest of the things in next session. Till then, enjoy and don't forget to revise your notes. Okay, and if you have any issue, you can contact the team. Okay, bye bye.